Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Well, gold has shattered records this year. Spot, of course, surging past that $2,500 per ounce U.S. mark. That's a historic high that's also raising big questions in the market. Now, with the Federal Reserve signaling rate cuts and global uncertainty driving investors towards safe havens, the key question now is whether this rally has legs or if we're teetering on the edge of a speculative bubble. We're also seeing renewed focus on critical minerals like copper as China aggressively secures its supply, trying to position itself as a leader in the energy transition. Now, to help us break down all of this, we're joined by Ed Coyne, the senior managing partner at Sprott. It's a firm that you know well with over $31 billion in assets under management, specializing in precious metals and critical minerals. Ed, welcome to the show.
Jeremy, thank you for having me.
Yeah, great to have you on. Thanks for making the time. I know it's a little bit of a crazy, hectic week. We just mentioned we've been seeing these beautiful prices on the chart for gold. I'm curious, we dig into the gold prices here at Kitco every day. I want to know more about what's driving these numbers and what's really driving the rally. I mean, has Sprott been seeing Western investors come back to the market?
Sure. So I think you have to go back to the beginning of the year. I think it surprised a lot of people or caught a lot of investors off guard. If you look at what was going on in the market, you had record high or 2-decade record high interest rates. That typically is bad for gold because you can allocate capital to simply a cash account to offset some volatility in a portfolio. You had a relatively strong dollar. That's typically also bad for gold because foreign investors buy and settle trades in US dollars. Yet gold continued to do well. And I think that the first half of the year, at least, was really a story of central bank buying. As they continued to print more dollars and different currencies all around the world, effectively, we were backing, or they were backing their currencies with gold without truly saying they were doing that. Yet central banks were aggressively and continue to aggressively buy gold. So that was sort of part A of the equation. What was interesting is gold continued to do well. Western investors really weren't paying attention, or if they were paying attention, they didn't believe the move. And we saw not just not capital coming into it, we saw actually capital leaving the space. That has changed in the last, say, 90 days or so. As a firm, we typically deal in the advisor community, the broker-dealer community, and so forth. And just a few years ago, we would do a couple requests for proposals or requests for information on our firm and our funds every year. This year, through the end of the second quarter, we've done close to 60. So advisors are sort of grassrooting and asking questions about us and the asset, particularly gold and silver, and then the energy transition materials as well. And we're starting to see the Western investors express interest again. And we're starting to see that from a cash flow standpoint of gold ETF starting to slowly go from outflow to flat to slightly positive now. And literally that's been the last couple weeks. We've started to see that trend start to reverse a bit.
Yeah, interesting. Okay, so then what do you say to those that, believe that the rally might be setting up for a sharp correction here? I mean, is there a FOMO effect? And is there a risk to investors that could be burned if they're a little too late to the party here? Or if you say, ETF flows are just coming back, maybe this is setting us up for something positive in the next few months?
That is probably the best question, and the question I get the most often. When I started with the firm close to 9 years ago, gold was considered expensive at $1,200. Then it was considered expensive at $1,600. Then it broke through 2,000 during the COVID pandemic, and people are like, well, we missed it. It's the trade's already happened, and now it's over 2,500. And if you look at gold over time, it's sort of slowly stair steps up, and it's really a byproduct of what you're seeing in the broader market. Because I always remind people, gold is a relative asset. It's relative to the rest of your portfolio. So when you think about it just in absolute terms, this is not a stock. This is a yellow rock that sits on a shelf, and it's an alternative currency. When you think about it in those terms, over time, it's going to appreciate. Now, there's going to be ebbs and flows, and there's going to be volatility in the pricing based on many factors out there. But this idea that you've missed a trade, or it's at a peak, or it's at a bubble, maybe in the short term, that could be true from time to time. But when you look at the long-term performance pattern of gold, over time, it's almost the inverse to the dollar. As the purchasing power of the dollar continues to go down, gold continues to go up. So I don't really think there's a high in any cycle. I mean, there's just a evergreen allocation to the space. Think about it in those terms and think about it relative to the rest of your portfolio, because it's really a tool for your portfolio more than anything else.
Yeah, you mentioned that it's obviously, markets are cyclical, but when we're sitting here at that path of resistance, $2,500 mark sitting, it almost seems like we have a new price being set here. I mean, I guess my question is if the dollar, if the purchasing power of the US dollar is decreasing, which again, we seem to think it is. Of course, there's debt that has that happening too that we can get into. But if that's happening, I mean, obviously gold's value is not really going to decrease here.
That's right. The stage is really being set for a prolonged rally in gold. If you look at all the things that are coming along, you just had the Fed say effectively we're gonna lower rates by 25, and there's some people even whispering that maybe it's 50 basis points, 0.5%. That tends to be very good for gold over full market cycles, a declining interest rate. Again, it's the inverse of what we said earlier about rates going higher, and that typically being bad for gold, yet gold did well in that environment as well. Typically in a declining rate environment, the dollar tends to flatline or soften a little bit as well. And you got foreign nationals looking to trade away from the US dollar as well. So I'm not saying the dollar is going to be replaced by gold. What I am saying is that the dollar has had a tremendous run here over the last decade or so. And if it continues to sort of stay in this area or even flatline a bit or even go down a bit, that's also good for gold. And we haven't even got into sort of the geopolitical narratives that are out there, what's going on from just a political standpoint, from a war standpoint, from an election standpoint. Those things move the price around as well. But there's a lot of things setting the stage to continue to support the narrative for allocating capital to gold. We're not saying it's going to 5,000 or something, but we're saying the environment still looks very healthy for gold to continue to climb higher.
Yeah, it was so interesting watching, I mean, we saw Jackson Hole, obviously. We saw that little bit of a pivot towards that dovish tone. I started the year pricing in 5, 6, 7 rate cuts this year. Obviously, we might see one. Some people, as you mentioned, saying two. How much of gold's current strength is tied directly to these expectations? I mean, what's priced in here? What makes sense?
Yeah, I think the word price is key. I think it has very little to do with the value of gold. But it certainly moves the price around a little bit. And those give you sort of entry points into gold. And I think the biggest mistake a lot of investors can make is trying to time when they buy and when they sell gold versus looking at gold as a percent of their portfolio. We have a lot of family offices, institutions, endowments that use gold as an evergreen allocation in their portfolio. And when you ask them how they look at it, they really look at it as a percent of their portfolio, as a weight in their portfolio. So if the year were to end today, gold's outperforming the S&P 500, and maybe your 5% allocation or 10% allocation to gold is now worth maybe 12 or 13% because it's outperforming the S&P year to date. So maybe you trade it down a little. Conversely, in years like last year when the S&P outperformed gold, in those environments, you'd be adding to it. And you're really focused on the percent in your portfolio and not the dollar value or the return. That becomes almost secondary. And so some of the most successful kind of storied investors out there that have used gold over multiple market cycles, they really focus on what percent of the portfolio it represents and why they're allocating to it, and not what the return is or what the dollar value of gold is. And I think that's a different way for investors to start thinking about the allocation, is looking at it as a tool in your toolbox to help you diversify. And the further you go out on the risk spectrum of other assets, the more gold you'd want to allocate to. If you're a more conservative investor and mostly fixed income and cash and so forth, maybe you need less gold. So it really is a byproduct of what the rest of your portfolio looks like.
Right. So that classic portfolio, we start looking at those numbers. It's changed over the years with these increases in gold prices.
It has. If you think about the old 60-40, that's a term a lot of people hear out there. Most people watching this interview are familiar with the 60-40 term, which is 60% equities, 40% fixed income. And if you simply looked at just, say, the S&P 500 and 10-year treasuries, and you said, okay, what happens if I take 5% of my 10-year treasury and put it into gold, and 5% of my S&P 500 equity allocation, put that into gold, now have a 10% allocation of gold. What's interesting is you look at over multiple market cycles, not only has it dampened volatility, it's actually enhanced your risk-adjusted rates of return. So we've seen this over multiple market cycles, not just on the current cycle, that gold's done very well. In fact, if you look at it year to date, it's outperforming. If you look at it on a 3-year basis, it's outperforming. If you look at it since the introduction of quantitative easing and financial engineering going back to early 2000, after the tech bubble burst, gold's actually outperforming. So as you widen your lens, you start to understand that gold is a very low-cost liquid way to hedge your portfolio and allow you to stay allocated into more risk-on assets.
Yeah, and how much of time do you got to spend focused on cutting through the noise here, looking at the fundamentals? I mean, you brought up central banks. We know that there's been huge purchases there. China, I mean, paused, and it caused a little bit of interesting pullback of support in the market. And I'm curious, without the strong demand from Asia, can Western ETF inflows alone sustain the rally? Like, where are we here?
Sure. And at the risk of going down maybe a conspiracy rabbit hole, which, I think all of our investors like to talk about that maybe over a cocktail conversation. But the reality is that, China and other large investors have a history of sort of talking down or talking back an asset that they're bullish in. And I'm not saying they did that purposely to try to buy more gold, but it was really short-lived. And we see that in some of the other markets out there, like copper, for example, where China's over 50% of copper consumption. They need it long-term. So whether the economy is slowing or growing is sort of irrelevant to the bigger picture there. And I think the same is true with gold. When you think about what other people are doing, and to your point, I think the best way to phrase it is what you said about shifting through the noise and sort of screening out all the other things that are around there. That has a lot to do with the price of gold, but it has very little to do with the long-term value of gold. And I think if you can look above or beyond the headlines and what's going on short-term and take advantage of when there's dislocations in the gold price, I think long-term it will benefit you if you're truly a long-term investor and not a trader in this space.
Yeah, it's fascinating. Sometimes just looking at the runway you give yourself, it changes everything. Okay, we had Robert Friedland on the show, actually on Kitco Mining. It was a fascinating copper panel last week. I encourage everyone to go and watch it. But, he made some jokes, and he made it clear that many people don't really grasp the full potential of copper in this energy transition, including analysts. With copper prices setting some new highs here, talk to me a little bit about the strategic importance of it. I mean, where are we within that market?
Well, let's start with this. We couldn't be doing this call right now without copper. Let's keep it as simple as possible, right? So, and we talk about copper from this energy transition standpoint, which I think is a wonderful narrative and it gets people engaged. But we're talking, the energy transition is really about the 1 billion of the 8 billion people on this planet. The other 7 billion, many of those don't even have electricity, or they've gotten electricity for the first time and they've bought their first refrigerator, their first light bulb in their home. And so not only are we looking for copper from an energy transition standpoint, we're looking at copper from a grid renovation standpoint here in the States, but also a grid expansion standpoint globally. And that's just basic block and tackle electrical needs. If you go into something like an electric vehicle, you got 3 times more copper needed in an electric vehicle. If you look at wind farms, if you take an offshore wind farm, you need 7 times more copper for that offshore wind farm than you do an onshore farm. So there's the demand for copper is really unending right now. And it's really the only true way to move electricity from point A to point B. As we get more advanced, a decade from now, maybe 2 decades to now, from large, movable battery pack power where you can actually store and create energy at the energy source and then move that through a battery technology at a large scalable level, you're going to need the copper to move energy all over the place from point of creation to point of consumption. Frankly, we just don't have enough of it. And if we have a new discovery tomorrow, it's looking like on an aggressive standpoint, 8 years, or more realistic standpoint, 12 to 15 years before you're pulling the first portion of assets out of the ground, from a refinement standpoint. So this is something that's not going away. People talk about the most recent move in copper. Those that have a larger lens say, well, copper kind of sold off the last year or so. I said, yeah, but, beginning of the decade, it was, around 2000, it went up to 10,000, sitting around 9 or a little bit over 9 right now. Copper is one of these things that long term, we're just going to need more of it. There's not enough of it. Recycling is not going to get it done. The current mines that are in operation aren't going to get it done. There's geopolitical hiccups along the way where you get walkouts. You get potential nationalization of mines and so forth. So this is going to be a long-term supportive narrative out there. Whether you believe in and subscribe to the energy transition or just simply understand that we need more electricity in more parts of the world, copper's at the forefront of that story, and that's not going away anytime soon.
No, it seems like it's almost like an M&A type of rally that we're going to go into within that space because there's just not enough of it. And you mentioned, I mean, China's securing massive supplies of copper and other critical minerals. They're really trying to position themselves as this global energy leader. Are we at danger here? I mean, I'm not seeing a ton of deal flow. Are Western markets and companies in danger of being left behind?
You know, it's interesting you say that. I think deal flow is going to be something you start seeing more of. Even at Sprott, without going down the product, avenue, we have a specific product that looks at smaller, mid to small cap mining companies that are ideal buyout candidates. There's two ways to go about this. You put CapEx into discovery, and then you hope to get the licensing and get everything through and go into production. Again, that in an aspirational standpoint, you're talking maybe 8 years if everything goes perfectly right. But realistically, probably more like a decade plus. And then the other option is just buy other mines that are out there that are in late stage development, early stage production or extraction, where they have a longer runway, and then build a portfolio of these different mines with different sort of quote unquote expiration dates of when they run out of reserves, which could be 2 decades or 3 decades out, depending on the mines. So you're going to see a basket of these types of M&A stories start to show up over time. We've certainly seen it in the gold space over the last couple of years. We've seen it in the copper space a little bit. We've even seen it in the uranium space. This is not going away. The world sort of woke up to the fact that, with technology and mining kind of go hand in hand. Whether it's, everything we do, how we do it, you got to start by digging a hole in the ground and pulling a resource out of the ground and then manufacturing it in some way, shape, or form through refinement, and then putting it into all the tools we use today. So I think the world's kind of starting to come with grips with that. And something as simple as ESG becoming more popular, I think has actually helped the mining industry because it's created everyone to be better actors in the space and be more responsible. And that's allowed institutions to start making the assets more investable for their portfolio. So I think there's a big win happening here that's just starting to be recognized, and just in the Western side of the investment community in particular, they're waking up to the reality that this is something that's not going away. We need it, and it's certainly more investable today than ever before.
Interesting. I know you can't answer too many questions about, giving stock tips or anything here, Ed, but when you're looking at some of these assets, I got to ask from an audience perspective, where's the trade? Where's the money to be made here? What are we looking at?
Sure. I always say, particularly for an investor going into the space for the first time, I always say start with the physical first, whether it's physical gold, physical silver. And, we haven't really talked about silver, but silver is a really unique metal because it's always lived in the shadow of gold, but it's really become its own person now with the energy transition. Silver is used more and more in things like solar and reflective technology for self-driving cars and cameras and so forth. But all of these metals, whether it's gold, silver, copper, I briefly talked about uranium, all these, critical materials and metals, I always say start with the physical first because gold miners are interesting, but they're still stocks. They have management, they have properties, they're in jurisdictions which are sometimes good, but sometimes bad. Things can go bump in the night there. And so if you're thinking about allocating to gold, I always say start with the physical allocation first. And as you get comfortable with that allocation, as you want to go further out on the risk spectrum, then start looking at the gold equity stocks. And you kind of start at the upper end and go down, just like the S&P versus Russell 2000. You'd want to start with the larger cap, more liquid names first, and then work your way down to the more junior opportunistic names second. The junior is going to give you more opportunity, but they're going to give you more volatility. So it really depends on what you're trying to do as an investor and how you're trying to allocate. But in my mind, if you're a first-time allocator to precious metals or critical materials, I always tell people, think about the physical allocation first and then graduate into the equity second.
Yeah, well said. And I mean, gold bar at 400 ounces just broke past that $1 million mark too.
That's right.
To be celebrated.
That's
Wild
right.
times.
And we only deal in the 400-ounce bars. So it's been an interesting number to see, cross that threshold. And, I know I have nothing to do with this, but when I joined Sprott almost 9 years ago now, gold has more than doubled since I've been there. So sometimes it's better to be lucky than good or lucky than smart. Frankly, I built
Good
my whole career
ROI.
on that.
Nice
So,
ROI.
yeah, over $1
right?
million a bar now. I mean, it's unbelievable to think about.
Yeah, it's wild. Okay, well, I'll get you on for another little update here as we see these interest rate cuts possibly in September, but we'll get a little update. Ed Coyne, he's a senior managing partner at Sprott, joining us today. Hey, thanks for this, Ed. I really appreciate coming on, making the time for us.
Thank you, Jeremy. I really enjoyed it.
Absolutely. Me too. Appreciate it. And thank you for watching. I'm Jeremy Szafron for all of us here at Kitco News. Thanks for tuning in. We got lots of great content all week. Hit that notification button, and we'll see you next time.